Mark Simpson, and I'm back with another investing topic for you. Today I'm going to be talking about investing mistakes. Now, this isn't a topic that is often covered by people doing investment talks because we don't always like to focus on the things we get wrong. We prefer to focus on the things we've got right. However, I think there's some incredible value in focusing on the mistakes that we make. And why do I think that? Well, the first is they provide big learning opportunities for us. Opportunity to improve your investing practice is very valuable. It should over time lead to improved investment returns. So therefore, learning and improving is an important part of being a successful investor. But there's several things that can prevent us from really learning from our mistakes. One of the first things can be what's called attribution bias. And this is to do with how we attribute success or failure. When we have successes, we often prefer to attribute these to our internal qualities. So our skill, our experience, our intelligence. But when we face mistakes, we often like to attribute them to external factors, things like bad luck or somebody else's fault. Knowing this, you can recognize this in yourself, and you'll probably be aware of times where you've suffered from attribution bias. And this can make it quite hard to really discover our mistakes and to learn from them. But I think it's a very worthwhile pursuit. And particularly, I think at the moment, I think focusing on mistakes can help us avoid what's known as hubris. Now, from Merriam-Webster here, gives a bit of a description of hubris. It says that in classical Greek tragedy, hubris was often the fatal shortcoming that brought about the fall of the tragic hero. Typically, overconfidence led the hero to attempt to overstep the boundaries of human limitations and assume a godlike status. And the gods inevitably humbled the offender with a sharp reminder of his or her mortality. Now, I think that anybody who's been investing for any period of time will know that the stock market is a little bit like the Greek gods. It does have the tendency to humble the person who attempts to have hubris or to try and overstep the boundaries of human limitations. The markets have this tendency, and I think this sort of market that we've faced over the last few years can be particularly hubris-inducing. I think a number of us will have had good 2020s or even good returns over the last decade. And this is the sort of time where hubris can take over. You see on the chart here that the stock market in the last 5 years has pretty much gone up with a few dips, but also those who bought the dips have been rewarded. So this is definitely something that may cause us to view our investing skills more greatly than they actually are. But before I go into some specific examples of the mistakes I've made, it's worth looking at what is an investment mistake, because I think it might be less straightforward than we first assume. People often have a very simple definition of an investing mistake. They think it's one where they lose money. And it can be quite hard to get round this thinking, but I don't think losing money necessarily means the mistake was made. Equally, I think people might think that selling before a price rise means that they've made mistakes. So, kind of losing money or missing out on making more money represents a error. To explain why I don't think that is, let's kind of think about some games where there's winners and losers. Any of these such games tend to sit on this spectrum between luck at one side, pure luck at one side, and pure skill at the other. So an example of pure luck would be Snakes and Ladders, for example, the children's game, or playing roulette. Most of the games in a casino are games of pure chance. That is, unless you're Claude Shannon, who invented the world's first wearable computer in order to predict the ball in roulette. For the rest of us, this would be a game of pure chance. And if we lost or won, it would be purely due to luck. At the other end of the spectrum, you have games of pure skill, like chess. If you lose at chess, it's because you've made a mistake. If you win at chess, it's because you have performed better than your opponent. However, any single investment outcome sits somewhere in between. It isn't purely skill, although skill gives you an advantage, and it isn't purely luck. It sort of sits in this in-between state. And this is why any particular trade or investment that loses money isn't necessarily a mistake. So how do we disentangle these aspects of skill and luck in our investing practice? Well, I think this is a really good table to bear in mind. And it's about differentiating between the process and the outcome. And you can see here that across the top you have good and bad outcomes, and down the side you have good and bad processes. So if you have a good investment process and you get a good outcome, then this is deserved success. However, you can have a good investment process, but that aspect of luck can come in place, and you can have a bad break. You can have a bad investment outcome despite your good process. Obviously, we want to try and repeat where we have a good outcome and a good outcome due to a good process. The challenge with bad breaks is that they might cause us to learn the wrong lessons. So when we have a good process but a bad outcome due to luck, this can push us to inappropriately adapt our strategy and maybe make adjustments to our investment process that aren't based on evidence or a large degree of evidence and aren't going to do us any good in the long term. When we have a bad process, it's equally possible that we can have dumb luck. We can get those good outcomes from that bad process. And again, this is particularly hard to learn from. If you've had a good outcome, you often focus on the outcome rather than the fact that was actually a lucky break, or it was dumb luck rather than deserved success. So before I look where I think we can learn the lessons, let me just give a couple of examples where I think the outcome I received was bad or not as good as it could have been, but my process was relatively good. And therefore these were bad breaks and they were not investment mistakes. So the first one I'm going to look at is a company called Xaar that do industrial printheads. I bought this as part of my net strategy back in March 2020. Nets are about buying at a large discount to current asset value and is a particular form of deep value strategy. And do check out my other YouTube videos on this, particularly the ones about deep value investing, if you want to learn more about this strategy. But what you'll find is that, unsurprisingly, you probably could have bought almost anything in this period and the stock would have gone up. However, this stock went up quite significantly. By the time it reached its results time in September, then it had generated a 5x return from my buy point. And I perceived that although this was a turnaround stock, it would still be heavily loss-making and therefore would be particularly hard to value at this level. So at this point, I took a large top slice and reduced my position size, correctly predicting that the earnings would be significantly negative during this period. However, this didn't stop this stock increasing further, maybe about another 60 to 70% from this point of top slice. And it did this on no news. So, and in the end, we still see the forward earnings prediction is for another significant loss. So, I don't think that top slicing here was a mistake. It's only hindsight that lets us know that this stock, carried on going up and went up significantly on no news, despite being heavily loss-making. Another not mistake, I think, here is looking at a company called Capital Drilling. So I perceived that the earnings for this company, and particularly the EBITDA estimates, would significantly increase for this company. And you can see that based on brokers' forecasts, that outcome did actually happen. Brokers continually forecasted rising EBITDA for the forward year for this stock. And based on this view, I added to my position at 72p. However, the rising estimates of EBITDA haven't led to an increase in share price. In fact, a persistent seller has reduced the share price, and an equity raise to fund a large contract has also caused some market upheaval. So again, I don't think this was a mistake. The outcome or the process that I followed, which was to analyze the future earnings performance of the company and show that was increasing significantly, that turned out to be correct. But the outcome wasn't what I expected, because this persistent seller meant that the price didn't follow. So if those are not mistakes, what are mistakes? Well, I think the biggest learning opportunities we get are what's called poetic justice in this table. So if dumb luck is hard to learn from because the success blinds us to the effect, poetic justice, where we have a bad process that leads to a bad outcome, actually provide the best learning opportunities. And when you have these outcomes that are less than ideal, and you realise that they were caused by a bad process, then this is the ideal time to learn something new about yourself or about the stock market. So here are some of the examples of mistakes I made in the last year. So the first mistake, and probably one of the biggest, was trying to be too cute on price. I'm a value investor. I like to get a bargain. But this has led me to be, too conservative on my target prices, particularly for quality companies that I knew were going to do very well, or do okay during COVID-19. Ones that were conservatively financed, wouldn't struggle with their balance sheet, and had genuine competitive advantage in some ways. So an example here is Solid State. You can see that I almost bought in the towards the March lows, but I was waiting for a round number. So again, this might be anchoring bias coming in as well. I was waiting to buy this stock at £2 per share. However, that £2 never arrived. And you can see from the bottom, this stock has generated 180% return so far. And I missed out on that because I was trying to be too cute on price. An even more extreme version of this is a company called Volex that do cabling for electric cars, amongst other things. So I actually attempted to buy this stock in March, and I was offered a quote of 80 pence to buy, but before I'd accepted it, the quote had been pulled. And again, this is a particularly illogical thing here. I was so incensed that my quote, what I thought was a good price that I'd been offered, had been pulled by the market maker, that I refused to buy at the new quote. I think I was quoted then 84 pence. So for me, paying 5% more at this point, just seemed wrong. So I never bought into this company, despite knowing that it was a well-managed business whose products were still in demand. And you can see this one, if I'd actually accepted the 84 pence I was subsequently offered, I would have generated 290% return. And I missed out on this by being too cute on price. The second mistake I made was straying outside my lane. So I think that often people stray outside their lane by buying maybe biotech companies they have no experience of, or particularly types of investments that they have no competitive advantage. But that's not the case here. This is a company I knew well and had invested in for some time, and it was doing pretty well this year. It recycles or the waste from gold mines to generate gold, and obviously with the price of gold doing very well, the company has done very well this year. Combined with a turnaround, it's gone up about 2 to 3 times its value off the lows. As it rose, this started to become too large a position in my portfolio for what I considered to be its risk-reward ratio. I was going to top slice at around, when the share price reached about 9 pence per share. However, when it did that, I didn't actually top slice. I ignored my own portfolio rules. And the reason was that I saw that people who were traders, people who bought breakouts and trade on chart patterns, were getting excited by this stock and were buying into that breakout. So I didn't follow my rules. However, that breakout didn't actually happen. And I suspect that the traders that invested in this are now long gone. However, I didn't do my top slice and subsequently felt about a 20% drop that was completely unnecessary if I'd stayed in my lane and stuck to my own portfolio rules. Another example here, but this one's a bit more about buying companies, straying out my lane in ways that I didn't really truly understand the company. So Medica do teleradiology. So this is remote analysis of CT scans. And CT scans were used by the Chinese as one of the ways of diagnosing COVID. So when this stock started falling at the response to COVID, I thought this was a great opportunity. However, and I bought at about £1.35. However, it turns out that this company mainly functions in the UK and Australia. Those were regions that didn't decide to use CT scans to diagnose COVID. And in fact, people who've invested in companies that have done PCR tests will know that has been the main way of determining that a patient is suffering from COVID. Because of this, the CT scans were not used for COVID, but also because hospitals were full of COVID patients, the regular scans that would normally be done in a hospital were simply not done. And this left Medica with excess capacity, and in the end I sold at a loss once my thesis had not worked out. But this wasn't my typical type of investment. This wasn't the type of deep value investment I normally follow. So therefore, in this case, straying outside my lane was a mistake. As a final example of a poor investment process, I've put the title here as insufficient research, but realistically, this was a very poor set of decision making on many levels. I bought into a company called Real Estate Investors that invest, unsurprisingly, in real estate. And I bought following a presentation that I saw the management give. It seemed a reasonable presentation, and I thought this would diversify my equity portfolio from normally trading companies into some property. However, what I failed to do was enough analysis on the management and the type of company this is. And when I looked into more detail, I noticed that, firstly, that property wasn't going to do very well due to COVID. And secondly, that the management paid themselves very well. And I wasn't sure that the interests of shareholders were aligned to the interests of management in this case. Which would be a reason for me not to hold a particular stock. With the effect of COVID, this started falling. However, surprisingly, there was some set of recovery. Early in April, it started rising again and actually reached a level that probably would have been a very reasonable price to receive. However, at this point, loss aversion kicked in for me. Again, if you want to know more about loss aversion, do check out one of my other YouTube videos where I look into that in detail. But as you can see, I hovered on the sell button, but I wanted a bit more. I wanted to get out without, taking a loss, without losing money. And of course, not selling at this point was was a very big mistake, because as you can see, the price kept on going down, and I actually, finally sold pretty much towards the lows. So in many ways, this is a tale of woe on many levels. I didn't do enough research. My thesis was poor. That property was as a good diversifier from my normal portfolio, and also loss aversion kicking in to prevent me from selling at a loss, or certainly early on at a loss. There's 3 examples of mistakes and things I hopefully won't repeat next year, and I'm already trying hard and focusing on discipline in certain areas in order to try and prevent making these sort of mistakes again. So that's the end of some examples of my own personal mistakes. So just let me leave you with a few takeaways. So the first is that mistakes aren't necessarily bad, because they provide us with these learning opportunities. Not every losing position will be a mistake. So it really it is good to have this matrix that I shared in mind to understand when we had deserved success, or a bad break, or we were successful because of dumb luck, but also kind of really take the time to work out where you had a bad outcome and a bad process, so that you can learn from those mistakes and hopefully change your practice and become a better investor. Before I go, just a quick plug for my book called Excellent Investing. It's available on Amazon, so do just search for that and it'll pop right up. The reviews so far have been pretty good. I thank you if you've already left me a review. I really do value hearing back from readers, and every review really makes a difference. If you haven't yet picked up a copy, please do so. I think you'll find some interesting ways, and maybe some ways you haven't thought about before, to avoid investment mistakes and improve your investment performance. Thanks for joining, and see you again next time.